Good afternoon, and thank you for joining us for today's Bracewell webinar, The Tax Cuts and Jobs Act, Its Impact on the Energy Industry. Today's program will take a look at the provisions of the Tax Cuts and Jobs Act most relevant to each segment of the energy industry, including all aspects of oil and gas, as well as conventional and renewable power. Topics today are going to look at business taxes, renewable energy credits, and financing transactions. Before we start, a quick housekeeping note that a reminder that all participants will be in listen mode during today's webinar. For your convenience, if you have questions, you may type those questions in the top right-hand corner of the box on your screen labeled questions. Time permitting, our speakers will answer these questions at the end of the three presentations. If time runs out, they have agreed to contact you directly with answers to your questions. So to get things started, I will turn it over to Liz and Steve, who will talk to us about business taxes.
Thanks, Jay. Hi, I am Liz McGinley. I am a tax partner in the New York office of Bracewell. I also head Bracewell's tax group. My practice centers on oil and gas and conventional power, both representing strategics as well as financial investors, including large private equity firms investing in space.
My name is Stephen Lorch. I'm a tax associate here in the New York office of Bracewell. I have a broad transactional tax background with a focus on merger and acquisitions in the oil and gas industry and private equity industry.
Well, as we all know, the passage of the tax reform occurred with remarkable speed. It really gained momentum when the final budget was passed on October 26th. The 400-page House bill was passed within 2 weeks, and the legislation was signed by Trump a little over 1 month later on December 22nd. Many commentators have noted that this rapid drafting process produced some vague rules and may have created more opportunities for tax avoidance than actual simplification. The administration has claimed that the lower rates and investment incentives in the Tax Cuts and Jobs Act would raise the GDP growth rates to as high as 3 to 5%, with the economic growth offsetting the decrease in the federal revenues from the decrease in the effective rates. The impact of this is yet to be seen on our economy, but the oil and gas industry's response and conventional power industry's response generally has been positive. The oil and gas industry retained many valuable benefits, including the deductibility of IDCs and percentage depletion, and there was no significant direct assistance to either the renewable or the coal industries, which we'll go into in more detail later in the presentation. Probably the change affected by the Tax Cuts and Jobs Act that is most significant, most notable in the press, is the reduction in the corporate income tax rate. As you all know, before the act, the maximum rate on corporations was 35%, and corporate earnings, subject to 2 levels of tax, were subject to a maximum effective rate of 48%, 35% at the corporate level, and again 20% on dividend distributions at the individual level. After the act, taxable income at the corporate level is subject to a flat rate of 21%. And therefore, corporate earnings received by an individual shareholder is subject to an effective rate of 36.8%, 21% at the corporate level, and the same 20% rate on dividends received by the individual. What are some of the impacts we expect to see in our industry as a result of the reduction in corporate tax rates? Well, over recent years, we have seen oil and gas companies restructuring their portfolios, and we expect to see that more corporations will be encouraged to dispose of unwanted assets at a gain at this lower rate. There likely will be less interest in complex transactions designed just to achieve a non-taxable spinoff under Section 355. Of course, in the financial accounting world, deferred tax assets on the balance sheets of corporations will have a lesser value. And tax receivable agreements, including those that have been signed up in Up-C transactions, are likely to be less profitable to their holders. But there is a question whether that will have any effect of deterring Up-C transactions going forward, as many of the upstream in the upstream industry did not have tax receivable agreements just because they weren't expected to pay out to holders, historic holders, for a significant period of time due to the expected large generation of losses through the expenditure of public funds early after the formation of the company. We don't expect that the reduction in corporate tax costs in the oil and gas industry will have any direct impact on oil or gas commodity prices, as those are set by worldwide supply and demand. And therefore, in those industries, we expect that the corporations will have increased cash flow from the reduction in taxes, which could be used to buy back equity, debt, or fund incentive compensation, which we've already seen heavily described in the press. However, in the regulated power and gas midstream markets, tax cuts could reduce the rates earned by those companies in regulated markets and thereby reduce revenues. Politicians are already calling for cuts in utility rates across the country, and regulated utility rates are set to allow producers to cover costs and also earn a reasonable return. Also, the rate differentials impact on the deferred tax assets of those companies is structured under a normalization method so that the deferred tax assets will be taken into account in rate decisions ratably over time, not immediately. But some of the regulated entities that are not currently up for rate reviews have been asked to track their cost up until the next rate case is heard. And there's also talk as to whether these reductions in cash taxes of regulated entities will in fact reduce rates to consumers, or whether they will be used to develop reserve funds for resiliency in the system in the event of future disasters which may impact either gas or electric power systems. What are some other changes impacting corporations in our space? Well, first, you know, there is the repeal of the corporate AMT, which required corporations to pay a minimum tax based on their alternative minimum taxable income, which was computed based on federal taxable income with the number of add-backs. This is significant for the oil and gas industry because they had a significant amount of add-backs, which often made them subject to the AMT, which also had a limitation on the deductibility of NOLs. Turning to the federal income tax utilization of NOLs, you'll recall that prior to 2017, losses could be carried back, all losses could be carried back 2 years and forward 20, and they were available to be utilized to fully offset federal taxable income. Now, as a result of the TCJA, the NOLs generated after 2017, so not all NOLs, but NOLs generated after 2017 are not going to be permitted to be carried back, but they can be carried forward indefinitely. Further, they are limited in their ability to offset federal taxable income only to the extent of 80% and no longer entirely. This limitation is significant to the oil and gas industry because of IDCs and percentage depletion, generated significant NOLs that many expected to eliminate federal income tax for several years to come without limitation. What do we expect this change in the NOL rules to have on corporate transactions? Well, as you know, in many corporate exit transactions, when the seller generated large deductions just prior to the sale, either due to large compensation expenses, severance payments, payments to advisors, they would often negotiate to carry that NOL back so that the seller received the full benefit of the refund that was achieved. That no longer will be available for losses generated after 2017, that immediate refund through a carryback, but they will be able to be carried forward subject to any limitations under Section 382, and therefore any benefit to the seller will have to result through a negotiation of the value of those deductions as between the seller and the buyer. With that, we'll turn over to Stephen for some of the impacts on pass-through entities and individuals conducting qualifying businesses.
Thanks, Liz. The new rules under tax reform provide an excellent opportunity for individuals who either operate businesses directly or indirectly through pass-through entities to reduce their effective tax rate on their business income. However, we've noticed, and I think that commentators and practitioners agree, that these new rules brought quite a bit of complexity and also a good bit of uncertainty just based on the way that they were drafted. We had the opportunity yesterday to attend, or on Tuesday, I'm sorry, to attend the New York State Bar Association's annual lunch meeting, and that was certainly the consensus among practitioners there that there's a great amount of uncertainty in this area, and we'll discuss some of those specific items in the coming slides. Under prior law, an individual's ordinary income, either earned directly or indirectly through a pass-through entity, was subject to tax at the individual graduated rates, and the maximum rate was 39.6%. The benefit for pass-through income under tax reform actually comes in two pieces. First, individual rates were reduced to a graduated structure with a maximum rate of 37%. And in addition, an individual is eligible for a deduction of up to 20% of his or her qualified business income from any business activities. And we refer to qualified business income as QBI. QBI, generally speaking, is taxable income, active taxable income derived from United States businesses. Generally speaking, it's effectively connected income under Code Section 864 principles. And it's determined separately for each business that the individual either directly operates or indirectly operates through a pass-through entity. Again, QBI is intended to be an active concept, so it excludes capital gains, dividends, interest income, and it also includes compensatory income for services performed by the individual, including guaranteed payments. One thing that we've been giving some thought to with the pass-through deduction is whether or not it would be available for a private equity-owned business in pass-through solution. And I think that we've gotten comfortable and we agree that that is probably would be the case, although we would point out that any income earned by a management company that's considered to be fees or management services income probably would not have the benefit of this deduction. So you'd have probably a benefit, but then also a limitation for the private equity industry. Another interesting point that came up with QBI, and that actually was discussed at length on Tuesday, as is currently drafted, if there's a 751A ordinary income pickup on the sale of a partnership interest, that's an MLP interest, that's a unit in a master limited partnership, that ordinary income is very clearly under the new rules, subject to offset by this deduction for QBI. It is not clearly stated in the law that this applies to garden variety partnership interests or partnership interests that are not MLPs. I think commentators agree that the better view is that the deduction should be available for this type of ordinary income, but it is certainly not clear from the statute as drafted. So assuming an individual's share of qualified business income is eligible to receive the full 20% deduction, and none of the limitations apply, which we're about to discuss, the individual's effective rate on QBI would fall all the way down to 29.6%. But again, there are two very important limitations to mention that can limit the benefit of the QBI deduction. And before we walk through them, we should mention these limitations apply only if an individual's taxable income for any year is equal to or greater than a threshold, and that the threshold is listed in the final bullet on slide 5, and we won't walk through the details, but there is a phase-in. So the first limitation, which we refer to as the W-2 wage limitation, caps an individual's QBI deduction at the greater of two amounts. And we should point out that this limitation does not apply to businesses conducted or operated by a master limited partnership. The two amounts are: one, 50% of the individual's share of W-2 wages for the business, and two, 25% of the individual's share of W-2 wages plus 2.5% of the individual's share of the tax basis of depreciable property used in the business. If you follow closely the current events and the buzz around the tax reform when it was in the process of being finalized, you may remember people accusing Bob Corker of signing on to the bill at the last second because of the 2.5% addition to the cap being perceived as benefiting the real estate industry. And Bob Corker was a real estate professional in his private life. A few thoughts on this. a lot of our oil and gas clients, we understand, don't have a tremendous amount of W-2 wages, either because they use independent contractors as service providers, or their service providers are actually owners in their flow-through structure, typically profits interest holders. On account of this, there may be a limitation to the W-2 wage cap, to QBI deduction here on account of this cap. What we've seen people think about is forming captive management services companies below their flow-through structure that would be regarded for tax purposes as a means of paying the W-2 income from that level, and then your profits interest holders could also be W-2 wage earners to the extent that they have sort of ordinary typical wage compensation. What we've also noticed, especially in the midstream area, is that the 2.5% in the second item, the second cap, the 2.5% availability for depreciable property will probably provide a benefit for midstream companies, especially because of depreciable property they have placed in service. Again, I think people view this as being intended to benefit the real estate industry, but I think we think it'll have benefits for oil and gas as well. And the second limitation will eliminate the QBI deduction for certain services businesses, which are referred to in the code as specified services businesses. And generally speaking, these businesses they fall into two categories. There are certain enumerated businesses which won't have the benefit of the QBI deduction at all. And those are service-related businesses such as health, law, accounting, and consulting businesses. There's also a general catch-all that will catch any business, the principal asset of which is the reputation or skill of one or more of its employees or owners. It's a very broad standard, and it's actually borrowed from the 1202 rules for qualified small business stock. There's not very much guidance in that context, and so far there's not very much guidance in this context either. And I know that, or we understand that a lot of our clients and practitioners as well are a bit concerned about how broadly that this limitation will be construed to limit the QBI deduction.
Thanks, David. So after tax reform, we are left with similar rates. So the maximum rate applicable to an individual on pass-through income without a QBI deduction is 37%, which really approximates the combined effective rate on corporate earnings distributed to an individual of 36.8%. So although they're close, with the corporate rate being ever so slightly lower, we don't expect to see an immediate change in the oil and gas industry from operating largely through pass-through form, unless publicly traded, or converting into corporate form. And also we expect that the pass-through rate will be lower, of course, if the QBI deduction is available, but that may be limited in the oil and gas industry, where there are, in some aspects, there are not significant W-2 wages, but often services are provided by oil field services companies and independent contractors. So in order to raise that limitation, oil and gas companies operating in pass-through form may consider consolidating or integrating those operations into their own employees to raise the W-2 limitation. This is not all apples to apples in the rate changes, because the individual rate reduction and the QBI deduction are not permanent, as is the corporate rate cut. Both are set to expire after 2025. So if the individual rate reduction and QBI reduction are not extended, the combined effective rate on pass-through income to an individual will rise to 36.8%, which would differ or be just below the maximum individual rate of 39.6% after the reductions are eliminated. So after 2025, there may be an advantage to operating in corporate form rather than in pass-through form, particularly if distributions to shareholders are delayed. So we are in conversations right now in situations, investments in JVs or private equity investments in pass-through vehicles, where you otherwise wouldn't consider adding a blocker corporation because maybe you had domestic persons, you don't have foreigners or tax exempts, considering adding a blocker corporation, particularly if you don't expect that blocker corporation to be making cash distributions. You would have the advantage of that income over time being subject to tax at the 21% rate, not passing through to the maximum individual rate of 37% and then reverting back up to the old 39%. You'd also be able to avail yourself of the state and local tax deduction, and you also would be free of the AMT tax repealed at the corporate level. With that, we'll talk about some of the taxable income changes, immediate expensing of capital items, and the interest deduction limitation. Stephen?
Thanks, Liz. So another great benefit under the Tax Cuts and Jobs Act is an opportunity for immediate expensing of certain business assets. Under prior law, taxpayers could claim a special depreciation deduction for qualified property in the year the property was placed into service. And that deduction was equal to 50% of the cost of the property as of 2017, and there was a scheduled phase down of the availability of the deduction through 2020. And for this purpose, qualified property generally was depreciable property with useful life of 20 years or less that was otherwise subject to maker's depreciation, and only property that was first placed into service and used by the taxpayer. Under the Tax Cuts and Jobs Act, the new rules for immediate expensing provide a 100% deduction for the cost of the property and for qualified property placed in service after September 27, 2017 and before January 1st, 2023, with the deduction being phased out by 20% each year through 2026. Under the Tax Cuts and Jobs Act, qualified property is defined a bit more broadly than it was under prior law. In addition to maker's property with useful life of 20 years placed in service first by the taxpayer, it also includes like property that the taxpayer acquires would acquire in an arm's length transaction. And this really presents a great opportunity for taxpayers to create more value when acquiring assets from unrelated parties based on the value of this immediate expense. We understand the view from practitioners and commentators right now is that this benefit would also apply to basis that's generated through the acquisition of a partnership interest and the operation of a 754 election, which could drive a basis step up under Section 743. That's not clear in the law necessarily, but I think it's generally understood that that should be the result, and the IRS on Tuesday's lunch expressed the same understanding. We should point out that taxpayers can elect not to apply the new 100% expensing regime for any class of property on a class-by-class basis for any year if they decide that they do not want the benefit of the 100% expense deduction, and rather they'd like to stick with the typical depreciation schedule under makers. One last point is that immediate expensing is not available under this new regime for property used in the trade or business of furnishing electrical energy or gas through either a local distribution system or the transportation of gas by pipeline, if the rates have been established or approved by a state or federal authority. This is not expected to put a chilling effect on capital investment by regulated utilities. Regulated utilities often do not utilize bonus depreciation because the increase in depreciation would have reduced their rate base and therefore stuck with ordinary maker's depreciation as well. And also, as Liz will point out and discuss next, these same businesses are not subject to the limitation on interest deductibility, so they won't see an increase in their cost and capital under that regime, which a lot of other businesses will.
Thanks, Stephen. So turning to our last topic, but certainly not the only topics under the Tax Cuts and Jobs Act affecting businesses, is the limitation on deductibility of interest, which in many ways goes hand in hand with Stephen's topic of immediate expensing. These rules replaced the former 163J earnings stripping rules, and they generally provide that the interest deduction, either for a corporation or a partnership, is limited to the taxpayer's business interest plus 30% of the taxpayer's adjusted taxable income, which generally is taxable income computed until the end of 2021 without deduction for depreciation, amortization, or depletion. Also in that calculation in 163J8, it includes that the determination of the adjusted taxable income will include other adjustments to be provided by the Secretary There is no current guidance on that, but per the New York State Bar Association meeting, the IRS stated that that guidance should be expected very soon. After 2021, the interest limitation is reduced to 30% of EBIT, so it is a more strict limitation. So most of our clients right now are focused on that lower limitation that will go into effect in the future. Looking at some of the impacts that this may have on the market, something that's interesting is in highly leveraged companies that may become distressed, it has the effect as the earnings of the distressed company drop, the interest deductibility similarly will decline, which could accelerate the distressed situation. So wondering if there'll be any further guidance affecting that. As I said before, that this limitation affects both corporations and pass-through entities, but the application to pass-through entities is fairly complex. It is determined at the partner level, but partners can deduct additional interest expense up to their distributive share of the partnership's excess taxable income, which would be the income limitation in excess of the actual interest deduction. So that presumably will have to be reported to the partners. It is unclear how the interest limitation for corporations is applied in the consolidation context. It is not clearly described under the rules. And also it seems to encourage the possibility of splitting debt between the partner and partnership levels, which doesn't seem to have any rational basis in policy. So it'll be interesting to see if they modify the partnership rules at all. The IRS representatives when speaking at the New York State Bar Association meeting did not seem to be great advocates of the approach that was taken, that the limitation was applied at the partnership level with the excess availability at the partner level. So that has the potential, we think, to be changed, although I don't think there are any expectations for technical corrections on the near-term horizon. The interest expense that is not deductible can be carried forward indefinitely, and partnerships allocate out this excess interest expense to their partners, who can deduct the interest in future years to the extent of their share of that partnership's excess taxable income. Again, as Stephen mentioned, this limitation, similar to the immediate expensing allowance, does not apply to regulated electrical power or gas companies, defined in the same manner as they were for the immediate expensing deduction. Again, they did not want to deter large capital expenditures that are debt financed by electric and gas regulated entities. But it is unclear how these rules apply. A major question in our industry right now is, what if you have a consolidated group or a series of businesses all conducted under the same umbrella of a partnership or a corporation that are not all regulated or unregulated, rather you have a combination. And what would you do in that situation with a consolidated group with debt at the holdco level? How do you determine the interest limitation in that situation? That is a significant issue in our industry right now, and guidance is expected to be released shortly. The other question is, what constitutes a regulated entity? As Stephen referred to, the rules say that the limit is not applicable if rates are established or approved by a government regulator. Well, that certainly would capture regulated utilities, but one question that's been raised in the market is, what about an independent power producer or merchant power that sells into competitive markets that are regulated by FERC? Does that also fall under the umbrella of being regulated? I think the prevailing view is it should not, but we need further guidance for that to be clear. And that wraps up our discussion on the general impact on business taxes. And with that, we'll turn it over to Liam Donovan and Vivian Ouyang to talk about the impact on the renewables industry.
Thanks, Liz. My name is Liam Donovan. I'm a principal in the Policy Resolution Group at Bracewell's Washington office. I spent the last several months in the legislative trenches. Hope to give you a sense of the context for the law and its impact on renewables.
Hi, I'm Vivian Ouyang. I'm a senior counsel in the tax group of Bracewell. I represent both energy companies and financial investors in all kinds of transactions in the energy and infrastructure space. with a focus on the power sector, including renewable projects. So Leah and I today will talk about the tax reform provisions affecting the renewable energy projects. Liam will give an overview of the roller coaster legislative process of the tax reform and how the provisions that affect the renewables came into being. After that, I'll take you on a deeper dive into the most significant tax provisions for the renewable energy space, namely the base erosion and anti-abuse tax, the reduction in the corporate tax rate, the 100% bonus depreciation, the change to the tax treatment of the prepaid power purchase agreement, and the repeal of the partnership termination rule. Now turn it over to Liam.
So as we got a taste of from that last presentation, this really was the most significant overhaul of the tax code in a generation since 1986. In light of that, it's kind of interesting that the approach that it took to renewable energy, which is not to really make major changes head on. I think if you judged it in a vacuum, you'd be making a mistake because you'd think that maybe this wasn't significant for renewables. I think that's clearly not true if you look at the broader context of the bill, but also because it's one of the more interesting subplots of the tax reform process. If you look at what happened to renewables within the process, everything comes out as a minor negative, but it ends up being a major improvement compared to the various iterations of the bill that we saw. So the anticlimax at the end was sort of doesn't give full credit to the roller coaster that we all rode on for that 3 months. So stepping back from a Don Rumsfeld sense, looking at the known unknowns, the biggest variables that we were looking at heading into this tax reform process was the PATH Act. The PATH Act was meant to be the extenders bill to end all extenders bill. It was a piece of the omnibus legislation that passed at the end of 2015. What it did was take the unwieldy group of tax provisions that were continuously extended year after year, and it tried to take many of them off the table. It made many things permanent. It had another bucket of sort of long-term extensions with phase out, and that's what it did with the solar ITC and the wind production credit, gave them long-term certainty, gave the markets a sense of the trajectory as it phased down. Everyone that was left behind, the writing was on the wall that you were sort of marked for deletion, unfortunately. So the most important thing for wind and solar was making sure that there were no changes made to the terms of that PATH Act deal. They like it, they want to keep it. Status quo was the most important thing. The flip side of that was if you were not on the right side of the PATH Act deal, you needed affirmative changes in this law to be back in the good graces of the law. So for those technologies that rely on the investment tax credit that were set to lapse at the end of 2016, and indeed did lapse at the end of 2016, that would be geothermal heat pumps, that would be fuel cell, combined heat and power, small wind, and others. They needed changes. The status quo was not good enough. Now, so the big question was, would they be restored and harmonized? The House bill was interesting because the House was not thought to be a place that was friendly to renewable technologies. If you look at the makeup of the House Republican Conference, and it is a majoritarian body, it's led by a chairman from Houston, very friendly to fossil fuel industry, and the conference as a whole was not seen to be friendly to subsidy and renewables in general. The curveball that they threw was they actually did restore the orphaned renewables to the PATH Act deal. So you had cheers from the geothermal industry and others who were seeking that sort of change. On the other hand, rather unexpectedly, perhaps not if you were skeptical of the House's posture towards renewables, it took a hack at the wind production tax credit. They touted this as keeping the terms of the PATH Act deal, but what it did was it would prospectively terminate the inflation adjustment for the wind PTC, as we'll see on the next slide. That was something that started out in 1993 at $0.015 per kilowatt hour. It actually had increased by 60% over the last more than 20 years. So that would have been a significant drop. Less clear, but I think gave more heartburn to the industry. It would have retroactively changed the eligibility requirements for claiming the production tax credit by altering the continuous construction requirement. What most projects used was the 5% safe harbor, which existed under IRS guidance. What the law would have done, or what the House version of the bill would have done, would have codified continuous construction guidance that would have rendered that guidance moot. And so if you had taken the 5% safe harbor, you would have been stuck and perhaps not eligible, at least not at the rate you had hoped for the PTC. With solar, was less of an important change, but in the long term, it would have repealed the 10% remaining ITC after 2027. Now, so this is just a look. It does give you a sense that had it been hacked back to a penny and a half, that would have been not good. And then when combined with the fact that given the phase out, you're only getting 80%, 60%, 40% going forward, that would have been a major problem. Enter the Senate. The Senate was always seen as more friendly towards renewables. If you looked at the states where senators hold power, particularly on the Finance Committee, this was the place where wind and solar were protected. And I think going in, one thought that the orphan technologies would have a good shake as well there. So having been in the House bill, people thought that those things were looking good from that standpoint. The Senate bill threw their own little curveball and just did sort of a head fake, and there was no energy title contained in the bill. Did nothing, left the status quo. So as we said, wind and solar very happy, keeps their deal intact, but bad news for the orphans who were left out of the deal. This was largely because if they decided that if they went down the road of dealing with extenders and some of the other things that needed to be dealt with, it could have potentially brought down the bill. And in the middle of the process, that seemed rather likely. I think now everything seems inevitable, but it was fraught throughout the process. What it also did was, despite the PATH Act being kept intact, it introduced these new variables that Vivian will get into later. But two main provisions in the Senate bill had people up in arms and led to a lot of advocacy at the last minute in Washington, D.C. As Liz mentioned, the corporate AMT was ultimately repealed, but for a time it was actually retained in the Senate bill, which would have jeopardized the value of the production tax credit. The good news there for renewables was corporate AMT being retained would have been bad for everyone. Getting rid of R&D and that sort of thing would have been a huge problem, and so it was an all hands on deck push against retaining AMT. On the other hand, the base erosion tax, which Vivian will talk about more in depth, would have made the PTC and ITC potentially worthless for tax equity purposes, or at least for those with significant international operations. This was something that had people's hair on fire in Washington, D.C., fought hard to fix in the next step, the next iteration, which was in conference. It was not necessarily always clear that this bill would go to conference. I think there was an expectation all along that whatever passed the Senate would probably be accepted by the House and signed into law by the president. One reason that didn't happen was because the last minute retention of the corporate AMT set off such a firestorm, I think, that it required this next step of the process, which ultimately was very good news for renewables, because as I said, the fight to try to restore the ability of PTCs and ITCs to offset this new base erosion tax needed this other bite at the apple. So what the House did by forcing conference was, excuse me, the corporate AMT was fully repealed, and the ITC and PTC were allowed to partially offset the liability under the base erosion tax. it's excuse me, 80% of BEAT liability could be offset by the ITC and PTC. Very importantly, given that it was starting at 0%. Now, the Orphans, as we said, fell out of the deal. Thank you. Chairman Hatch, shortly after the bill was passed, Chairman Hatch released an extenders deal, which would restore the Orphans to the PATH Act phase-out schedule. Right now, that is captive to the broader standoff going on in DC. There is a new deadline after we had a 3-day shutdown, but a new deadline of February 8th. The optimistic scenario would be that these provisions ride along with whatever deal can be cut in Washington, D.C. I think the odds of that happening depend on your expectation that these immigration issues and some of the other broader issues can be resolved. But the best case scenario is that you'll see something happen on the Orphans by mid to late February.
Thanks, Liam. So as Liam mentioned, the base erosion and anti-abuse tax is one of the most significant provisions for the renewable energy space. The BEAT, this is also a short for it, called the BEAT. The BEAT essentially imposes a minimum tax on multinational corporations. It measures the difference between this imposed minimum tax and this corporation's regular tax liabilities as reduced by tax credits other than those that are carved out. If there's a positive difference between those numbers, then the taxpayer will pay that amount as a base erosion tax to the government. So unless they are carved out from this formula, any tax credits that reduce the corporation's tax liabilities below the imposed minimum tax will be clawed back in the form of the base erosion tax. This imposed minimum tax equals a percentage of the adjusted taxable income, 5% in 2018, 10% from 2019 to 2025, and stepped up to 12.5% in 2026 and after. The tax credits that are carved out from the formula and that can offset BEAT liabilities are the research tax credits and 80% of low-income housing credits and 80% of PTCs and ITCs. Since only 80% of the PTCs and ITCs are carved out, 20% of PTCs and ITCs are still potentially subject to this clawback. As we discussed, this is an improvement definitely from the original Senate bill, which would have subject 100% of the PTCs and ITCs to BEAT, but unfortunately doesn't provide a complete exemption. In addition, these carve-outs are only applicable to taxable years before 2026. In 2026 and after, the regular tax liabilities are reduced by all tax credits, which means that all of the PTCs and ITCs claimed by a taxpayer may be clawed back as BEAT by the IRS. And then Liam will talk briefly about the outlook for 2026 and after on the carve-out.
So this wasn't really a policy decision. This was entirely a budget gimmick. It was meant to help them fit about $500 trillion in cuts into a $1.5 trillion reconciliation instruction over 10 years. So what they did was they structured it so that in 2026, as Vivian mentioned, the rate ratchets up so they could squeeze some more revenue out, and the credits were no longer able to offset, which gave the broader base of income to tax. So it's mostly budgetary smoke and mirrors. Now, they will need to do something in 2026 to keep this going. But as Liz mentioned before, and as Stephen mentioned before, this is not the only thing that expires in 2026. Much bigger and the sort of macro level consideration will be the fact that the entire individual title expires in 2026. That's not only the individual and family provisions, it's also the pass-through provisions. So as we saw in 2013, with the last time there was a big fiscal cliff, there's going to be immense pressure to extend what is deemed middle-class tax cuts. I think there will be a big political fight over this. It'll be heading into an election year. But I think that it's hard to say what Congress will do at any given time. At this point, we have no idea who will control Congress by that time. But I don't think it's fair to assume these will be allowed to lapse. but we just don't know what the outlook look like after 2026.
Yeah, so we'll have to. This is one of the big items for the renewable energy industry to do for the work with the government to make sure that this carve-out will be extended. So more work to come in that space. The BEAT doesn't affect all taxpayers in all taxable years in the form that it's enacted. It only applies to large corporations with average annual gross receipts of at least $500 million for the past 3 years. And it only applies to such a corporation in the year when this corporation's base erosion percentage is 3% or higher. The base erosion percentage measures the deductible cross-border payments made by the corporation to its foreign affiliates relative to such corporation's total deductions for the taxable year. If that percentage is higher, 3% or higher, the government thinks that the corporation has too much deductible payments to foreign affiliates that reduces the tax, its U.S. taxes, and should be subject to BEAT. As a result, big multinational corporations with significant foreign operations are most likely to be affected, such as U.S. subsidiaries of foreign banks and other financial institutions. Those U.S. subsidiaries tend to make large amounts of deductible payments to their foreign affiliates. Next on the list would be U.S. corporations with foreign affiliates, especially the ones with a lot of deductible payments going outside of the U.S. On the other hand, corporations with only U.S. operations and no foreign affiliates will not be affected, or corporations, U.S. corporations that can manage its deductible payments to foreign affiliates can avoid being subject to BEAT as well. Therefore, the effect of this provision on the tax equity market would depend upon how many tax equity investors will not be affected and how many tax equity investors will be confident that it will manage to avoid the application of BEAT. The BEAT also has a retroactive aspect to it. That is, there is no grandfathering rules for existing operational projects that are already funded before 2018. Tax credits derived from this project could be still subject to BEAT. Because 20% of PTCs and ITCs may be clawed back, the BEAT provision may reduce the availability of tax equity capital, because now the equity investors will be careful not to trick the 20% clawback. BEAT creates the risk of uncertainty for tax equity markets. This is because a corporation doesn't know whether it would be subject to BEAT in a given year until the end of the year, when it has all the information to calculate its income, regular tax liabilities, and base erosion percentage. It is especially troublesome for wind projects claiming PTCs, because PTCs are generated for 10 years, and it is hard to predict how BEAT would apply over the life of the project. So for deals with tax equity investors that could be subject to BEAT, we expect to see a lot of negotiations around the allocation of this risk. There are a few structures that have been talked about in the market that could be employed to either mitigate or allocate this risk. One alternative is for the wind project to elect to receive ITCs in lieu of PTCs to mitigate the risk of uncertainty. ITCs are claimed in the year when the project is placed into service, and it is easier to predict whether BEAT would apply in 1 year as opposed to over the 10-year period for PTCs. However, ITCs are claimed as a percentage of the capital cost of the project, whereas PTCs are based on the electricity generated. As technology getting more efficient in producing electricity over its capital cost, there is a worry that claiming ITCs will likely reduce the amount of available tax credits. Wind PTC projects can also employ a pay-go structure where the investor would invest only a portion of its committed capital up front, and then the rest over time based on the PTCs actually produced, as well as not clawed back under the BEAT, compared to a structure in pre-2018 transactions where the developer typically doesn't take the risk of whether those PTCs would be used by the tax equity investors. This structure would allocate the risk to the developers, and that would definitely be a precious point for the developer and the equity investors to negotiate in a deal. Other than the BEAT provisions, the next big item on the list for renewable energy is the corporate tax reduction. the corporate tax rate is reduced from 35% to 21%. To profitable renewable energy projects, like any other profitable business, the effect of the reduced tax rate is, of course, a positive on after-tax cash flow. So that's good news for cash equity investors as well as strategic buyers with tax capacity of themselves to absorb the tax attributes. But the effect of the reduced tax rate is mixed on the tax equity market. First, it may reduce the available tax equity capital because tax equity investors invest in renewable projects to receive tax credits and deductions to shield their federal income taxes. If their income tax liabilities decrease as a result of the reduced corporate tax rate, so would their appetite for renewable projects. So everything else being equal, a reduced tax rate would mean less available tax equity capital. In addition, the pricing of the tax equity capital would also be affected because the return of the tax equity investor is measured on an after-tax basis. We'll talk about that more in the next slide. The return of the tax equity investor is measured on an after-tax basis on three components: the after-tax benefits of tax credits, of tax losses generated from depreciations and interest deductions, as well as after-tax benefits of cash distributions. The after-tax benefits of tax credits are not affected because $1 of ITC and PTC always offsets $1 of taxes unaffected by the rate. It may be limited by BEAT, as we discussed. But the after-tax benefits of tax depreciation deduction would be negatively affected. Unlike tax credits, depreciation doesn't offset tax liabilities dollar for dollar. Instead, depreciation reduces taxable income. After-tax benefits of depreciation is the product of the effective tax rate times the amount of tax depreciation. So for every $100 of tax depreciation, for example, the after-tax benefit would be 35 under the 35% tax rate and only 21% under the only $21 under the 21% tax rate. So in calculating the tax equity investor's return from the project, the same amount of depreciation generates less after-tax return to the investor under a lower corporate rate. So this would have a positive effect. The reduced tax rate would have a positive impact on the after-tax benefits of cash distribution. The effect on the existing projects, though, would depend upon in what stage the existing projects are. Tax depreciation is typically taken in the first few years of the project. So the earlier the project is in its life cycle, the later the project is in its life cycle, the less effect the lower tax rate would have on the project. Because for those projects, the existing projects that are later in their life cycle, they would already have exhausted the tax depreciation. So the lower rate may actually benefit those projects because they provide a higher after-tax benefit of cash distribution. But for those projects that are just started and have not exhausted their tax depreciation, there may be some ripple effect because now a larger share of cash likely will need to be distributed to the investors to compensate for the lower return from the depreciation. That will draw some cash available to service project debt or pay the equity distribution to the developers to service their back lever debt. Next item is on the 100% bonus depreciation. As Liam and Stephen and Liz explained in more detail previously, the 50% bonus depreciation is increased to 100% bonus depreciation for properties acquired and placed into service after September 27, 2017. And also used properties are now eligible to take this bonus depreciation. The taxpayers can also opt out of the bonus depreciation, as we explained before. The effect of this 100% bonus depreciation on the tax equity market overall may be muted, not so significant. That is because, especially in partnership flip structures, the tax equity investors have often opted out of the previous 50% bonus depreciation and instead choose to depreciate over the makers, which is 5 years for wind and solar assets. This is partly because the tax equity investors have a finite amount of tax capacity to absorb the tax credits and depreciation, so they would rather spread that scarce resource over multiple projects. Another reason is that in a partnership flip structure, allocation of partnership losses generated from tax depreciation is limited by the tax equity investor's capital account balance. When the capital account balance starts with investors' invested capital and is decreased by the allocation of losses, when that capital account gets to zero, no depreciation can be allocated to the investor unless the investor agrees to pay back the partnership an amount equal to any excess allocation, which is referred to as the deficit restoration obligation. Tax equity investors generally don't like to have significant DROs. They need to make sure that in all stress situations, the DRO would reverse back to zero upon the exit. So they would rather not have significant DRO and run the risk of not reversing back to zero. In 2017, in anticipation of the tax rate decrease, which would decrease the after-tax benefits of depreciation, as we discussed, more projects have elected to take bonus depreciation before the tax rate goes down in 2018. But now that we are in the lower rate environment already, most people in the market expect that it will return back to the norm, that most likely the projects in partnership flip structures will elect out of the 100% bonus depreciation and just take the accelerated 5-year depreciation. Another structure, with the sale leaseback structure, provides better opportunities to monetize the tax benefits of 100 bonus depreciation because the lessor, which is the tax equity investor, is not subject to the loss allocation limitation as they would be in a partnership flip structure. On the prepaid power contract, some renewable projects use prepaid power contracts under which the off-taker pays the supplier in advance for a share of the electricity to be delivered under the contract. Prior to the TCJA, if the prepaid power contract is properly structured, supplier of electricity does not have to report taxable income when the prepayment is received. Rather, it reports taxable income over the entire period during which the electricity is delivered. That results in a deferral benefit to the supplier because it receives cash first and reports taxable income much later. The TCJA requires such prepayments to be reported immediately as income, or at best, partly in the year the prepayment is received, and the balance in the year immediately thereafter. So there would be no deferral benefits to the supplier going forward in the prepaid power purchase agreement. The last item is the repeal of partnership technical termination. Before the TCJA, a partnership would be treated as terminated for federal income tax purposes if 50% or more of the partnership interest is transferred within the year. As a result of such termination, all depreciation will be restarted, thereby reducing the value of the depreciation. In partnership flip structures, the restarted depreciation would reduce the after-tax return of the tax equity investors. Therefore, provisions in the partnership agreements for the deals were always very carefully negotiated to restrict transfers and also indemnify the tax equity investors if such termination occurs. This is repealed by the TCJA, so going forward, there wouldn't be any termination of the partnership for federal income tax purposes to restart the depreciation, and those limitations to avoid the technical termination would no longer be necessary. So everything considered, the tax reform has some negative effects on the renewable projects, like Liam discussed, but the final tax bill is unquestionably a big improvement from both the original House bill as well as the Senate bill. There will be some work to be done on the legislative front for the carve-outs in 2020 beyond 2026, and some other respects, but by and large, the final bill is an improvement. The combined effect of the BEAT and the reduced corporate tax rate will likely reduce somewhat the amount of the tax equity capital available, but not significant enough to disrupt the market in a fundamental way. So overall, the market is expected to function as before, relatively well, maybe with some added complexity to the deal structure and the negotiations to address and allocate the risks that we just discussed. With that, we turn the microphone to Michelle and Ryan to talk about finance industry and the tax reform.
Thank you, Vivian. I'm Michelle Alexander. I'm a tax partner in the New York office of Bracewell. I have a wide range of experience in a number of corporate transactions, including mergers and acquisitions, private equity, fund formation and structuring, and of course, private equity deals, REITs, complex debt and equity financing, cross-border investments and inbound investments. And at Bracewell, I work very closely with our finance and capital markets groups on many types of financings and debt and equity restructuring.
My name is Ryan Davis. I'm an associate in the New York office in the tax group. I focus primarily on financial transactions, both lender and borrower, with particular emphasis on lender side transactions, as well as some M&A work, all focused on the energy sector. And you'll see these are the topics we'll be covering today. You'll see some of these provisions have been touched on in prior presentations. However, we are covering specifically the impact they're going to have on the financial services industry. So we'll start with the interest deduction limitation, discussing the effect it will have in the lending market, as well as implications for cancellation of indebtedness income and certain provisions in lending agreements. We'll then move over to the limitation on NOL carryovers and potential issues with debt restructuring. We'll then move on to select international issues, such as the BEAT tax that Vivian just discussed at length. We'll be specifically touching on an issue with double taxation that may affect financial institutions. We'll then move on to the global intangible low tax income, or GILTI tax. Then discussing so-called hybrid transactions, and time permitting, we'll discuss control form corporations. There were some issues we expected to be addressed that were not addressed, and new ones that have come up as a result of tax reform. The interest deduction limitation, as was touched on by Liz and Stephen, under prior law, payments on debt generally were deductible with certain limitations, as we've noted here, earnings stripping rules. This made debt financing particularly attractive to borrowers. Now, under the TCJA, borrowers can only deduct up to the sum of business interest and 30% of adjusted gross income. Any interest disallowed by this limitation can be carried forward indefinitely. However, the obvious problem arises if you have business operations that are such that you will consistently have interest payments that exceed the limitation. That will never be able to be deducted. Earnings stripping rules are also now repealed, and there are exceptions for small taxpayers whose annual gross receipts over a prior 3-year period average less than $25 million, and for certain regulated public utilities as well.
Thanks, Ryan. I think we can say very generally that the change here makes the interest limitation deductions apply more generally without regard to who the borrower and the lenders are. Again, very generally and broadly speaking, because interest deductibility always has been subject to some limitations. So it is a sweeping comment to say, if I take it in context, that generally you are more likely to have an issue with interest deductibility when you had a related lender. This is obvious in the earnings stripping rules, which are now repealed. They generally could be fairly easily managed because of that 1.5 to 1 debt to equity ratio. But even aside from that, assuming that you could pass muster under the earnings stripping rules, you had to pass muster under kind of general debt equity characterization. That generally does not impact banks, of course. Banks tend to be unrelated parties when lending to borrowers, but with a lot of financings with investors such as private equity investors, where they could be both debt and equity investors, these issues would come up much more frequently. Now that the field has basically been leveled in that respect because everybody is subject to these limits, it will be interesting to see how this plays out a number of different ways. For example, will the IRS be as keen to recharacterize debt as equity in light of the new limitations? Obviously, we're still very early on, and we don't know how that will play out because we'll first have to see returns be filed and returns be challenged. I think that the biggest group that may benefit here are private equity lenders, because private equity does have a bit more flexibility than banks to both be a lender of debt and be a preferred equity investor. So now that they are, I would say generally, again, because there are still, even though we have new limitations here, there are still other limitations on interest deductibility. And the new law adds other layers of deductibility limitations that we'll get into. But overall, I think some of these types of investors can relax a little bit and realize that they're treated in some respects the same as a bank lending in. Now, private equity, of course, private equity funds do have more flexibility to invest in equity. Banks can, generally they don't. Sometimes banks have to take equity in certain types of workouts. We've seen that happen. Sometimes banks have relationships with smaller investment bank arms that can make private equity investments. This is something we may see. I think that the first thing we thought when these interest limitations came out and actually became law, we thought, gee, we might actually see a decline in borrowing. It's really hard to tell, to be perfectly honest. It's always difficult to predict behavior, especially immediate responses to changes in law like this. We did see some articles saying there's been a freeze on borrowing in December. I think they were probably a little bit overstated. There are just as many articles saying that borrowing activity is up. So I think we're really going to need to sit back to wait to see what happens a little bit. One thing that does come into play, and actually some of the things that we're all talking about kind of fit together and cross over in some respects better than some of the provisions of the new law, which we'll get to, particularly in the international context. But here, interest deductions, of course, lower taxable income and sometimes generate net operating losses. We know now that net operating losses are a little bit less valuable given the repeal of the carryback and the limited carry forward to 80% of taxable income. But also, whenever you have a lower corporate rate, of course, the tax benefits are less valuable. So that's something that we'll have to keep an eye on. Now, of course, all of these interest deduction limits, both these and the ones we'll talk about later in the international context, are U.S. based. So we actually are already seeing some rumblings in the financing markets to replicate some of the things that we're losing here or being limited here. For example, this interest deduction limitation. How about we replicate something and do something in Europe and Luxembourg and the Netherlands? Well, one thing that we have to keep in mind is that the U.S. was not exactly the leader in tightening interest rules and tightening rules that would allow us to get away with the transactions that we've seen over the past several years. Certainly in the past 10 to 15 years, the rules have tightened, and we've been in line effectively with what the OECD wanted to see from us. But I think when we go beyond the U.S. to see which jurisdictions have more unlimited interest deductions and perhaps even higher rates that make those interest deductions more valuable, we'll have to see what happens with other countries, because just like the U.S., these other countries are under incredible international pressure to basically toe the line. One more point on funds. Funds themselves, of course, are lenders, and they are equity investors. As Liz noted, blocker corporations may be more valuable in light of some of the changes of the law, including the lower tax rate. Blockers do borrow, and depending on the type of blocker, for example, a single investor may have its own blocker to effectively block a trader business so they do not have effectively connected income in the case of a foreign investor. In that case, that kind of blocker may have borrowed subject to earnings stripping rules. Now, of course, there's just an overall limit on interest deductibility. So another factor in do we have a blocker will be how much can we leverage in light of the new limitation and whether it makes sense. And again, to Liz and Stephen's point, they're still being taxed at a lower rate. So that it's just another factor to throw into the analysis. Now, as Ryan noted, the new interest deduction limitation has an indefinite carry forward of the interest that cannot be deducted. This raises a number of issues that are really, I think, for tax lawyers very interesting at this point, but I think we're going to start to see them play out as this actually becomes relevant. As since this is all really starting now, we'll start to see the impact, I think, later in 2018, and as people are starting to report the consequences of some of their transactions. For example, cancellation of debt income is something that troubled debtors worry about all the time when they're restructuring their debt. Generally speaking, cancellation of debt arises when a borrower settles debt at a discount or is deemed to, such as when it exchanges its debt for equity that's worth less than the face value of the debt. Other rules may come into play to give a debtor COD income even when they're not expecting it, such as when a related party acquires a debt at a discount. One very important exception to COD income is a payment that would be deductible if the borrower actually paid it. So an interest payment is forgiven, then generally speaking, it's not included in COD to the extent that it would have been deductible. Now we have an indefinite carry forward. So what can that mean? Well, if you look at the carry forward, it is in fact indefinite. So there's at least literally an interpretation of that limit to say, well, it would be deductible eventually, so that shouldn't be included in my cancellation of debt income. I foresee this coming up perhaps with the IRS challenging a debtor that takes that position when, for example, it's a troubled debtor, which tends to be the case in the case of COD income. They may not have projections that would support being able to deduct that interest for any foreseeable taxable year in the future. So if, for example, a debtor excluded that payment from that interest obligation from COD income on the basis that it would be deductible at some point, I think we could see the IRS saying, well, that there's just no meaningful likelihood that you would ever be able to deduct all that interest, and therefore at least limit the exclusion from COD income to the interest that could be deductible subject to the rule. We may see, I don't think this will be a technical correction, we may see regulations on this, but I think in terms of workouts, that's probably the biggest issue that carryover raises. Now, of course, everybody's reevaluating their structures in light of all of these new laws, including, of course, the limit on interest deductibility. Issuers of both public and privately placed debt may consider redeeming. Whether or not they can really will depend on the indenture. Many indentures have optional redemptions, although at a premium. We have seen a decline in indentures and notes that have change in tax law redemption provisions. These can say anything from we can redeem, also usually at a bit of a premium, but usually less of a premium than optional redemption premiums, which would be for any reason. The tax law redemption provisions range from we can redeem if the interest on this debt would not be deductible, or it may say something very general, like if there was a change in tax law. Viacom last year issued debt with that type of redemption provision because they were anticipating significant tax reform. Where you have a change in tax law provision that rests on the deductibility of the interest, I think you have a similar issue to what we just raised with respect to COD income, which is, well, we might be able to deduct it because we can deduct it forever, but it really may depend at the time as to what projections show in terms of how much of a limitation that 30% is. So that is something to keep in mind. And of course, there's always the question of the premium and how much of a premium you have to pay.
Moving on to limitation on net operating loss carryovers. Just to quickly recap, under prior law, a corporation could use 100% of their net operating loss carryovers to shield taxable income. They could carry those back 2 years or for 20. Now, under the TCJA, that's limited to being able to use 80% of the net operating losses to shield income. No carryback anymore, and they can carry it forward indefinitely.
So there are a couple of things that this limitation raises in addition to what we've already covered. For example, credit agreements often have tax distribution provisions that allow the borrower to actually take out income to pay tax. This is relevant for partnership and LLC borrowers, as well as corporate subsidiaries in a consolidated group that may have to make payments up to its parents. Now, of course, these distribution provisions can be very simple in a sense that you decide a hypothetical rate, you pay them out, and you pay out the distributions, and you move on. I think this is one of many areas where it may not yet be clear if overall there's going to be a net reduction or increase in what a borrower needs in terms of a tax distribution going out. For example, the borrower may be limited in deducting the interest on that particular debt, which by itself would increase taxable income. However, corporation now has a 21% rate, which of course would would offset the limitation on the interest deductibility, and because of the lower individual rates for individual members of pass-throughs, and of course that deduction that Stephen talked about. Overall, there's still a little bit of a reduction on that side. So I think it really will depend on individual borrowers in terms of how much that distribution goes up or down. Also, Liz touched on tax receivable agreements and up-C structures. In credit agreements involving up-Cs, usually the LLC is the borrower or the partnership is the borrower, and the up-C will need distributions not just to pay its taxes, but to meet its obligations under tax receivable agreements. Because of changes in the law that we've gone over here, I think with some repetition, but it's worthy of repeating. For example, depreciation deductions that are the subject of these TRAs, for which the up-C pays historic owners of the property, usually about 85% of the value of the depreciation deduction. Again, lower rates means the value of the deduction is lower, so that may decrease how much money an up-C needs to get out of the LLC in order to meet its obligations. Another place where this limitation may come into play, again, going back to troubled debtors that have taxable COD income, which isn't that common, at least historically, because a troubled debtor, or really technically a bankrupt debtor, a debtor in bankruptcy, or an insolvent debtor can exclude COD income at the cost of reducing certain tax attributes. However, if a taxpayer is insolvent but not in bankruptcy, it's only able to exclude income to the extent it's insolvent. So generally speaking, only to the extent its liabilities exceed the fair market value of its assets. So because of NOLs being limited, we could see situations that we haven't seen before. Typically, when a company is considering a restructuring and will have COD income, it's a question of, do they exclude COD income and reduce their NOLs, because that's one of the tax attributes that gets reduced, or do they have taxable COD income and use their NOL carryovers to offset? Well, if they're not insolvent enough to exclude the income, we'd have a situation where they could have taxable COD income, which of course is not cash income, and not be able to use all of their NOL carryovers because of the 80% limitation. This is not something we've seen a lot of before, because typically the NOLs are sufficient to either be reduced under the insolvency rules or to offset taxable income. So turning back to Ryan, he's going to recap the BEAT tax and give us a little bit of color as to how this affects the industry. Just a note as we go into all of these provisions, I think one of the biggest criticisms of these rules, primarily the BEAT tax, the GILTI tax, and even the hybrid tax, is that Congress really wanted to target effectively manipulating taxable income by really targeting deductible payments to affiliates in low tax jurisdictions. We see that in the BEAT tax, we see that with the GILTI tax, but there are really unintended consequences. We suspect that we'll see this addressed through technical corrections, but we don't know how long that will take, and we don't know how far they will go. But it is, I think, something to keep in mind that these provisions don't really work together as well as they probably should. And in particular, we've seen, and I think anybody who's been paying attention to tax reform has been very focused on the fact that we now have a territorial system for U.S. corporations. Well, we do, except for where we don't, because not only have the rules on controlled foreign corporations and subpart F income not been repealed, but we actually have increased tax liabilities under that. And with that, I'll turn it to Ryan.
Great. BEAT was already discussed at length by Vivian, but I'll quickly recap. It's supposed to target large taxpayers with average annual gross receipts of $500 million, the $500 million of which is effectively connected with the U.S. trade or business. It's meant to prevent them from reducing their taxable U.S. income by making deductible payments to foreign affiliates. As Vivian noted, BEAT has an effective rate of 10%, but we phased in. That phase-in is 5% generally in 2018, but 6% for financial institutions. And this increases to 12.5% in 2026. The specific issue we want to discuss is one, as Michelle alluded to, regarding potential pitfalls from hasty drafting. Specifically, the law does not specify if a determination is made on a gross or net basis, and this could result in an issue of double taxation. The specific situation that we're envisioning is you have a foreign financial institution that has a U.S. branch, U.S. unit, and that unit receives a payment, and that payment is taxed in the U.S. They then make a payment to the foreign financial institution, and it's unclear whether that payment is taxed on a gross or net basis, which would, if taxed on a gross basis, will result in double taxation. This is perhaps unintentionally broad. Again, we have to wait and see if we have some sort of guidance promulgated in the future or regs that clarify this calculation.
Banks Impact specifically stood up and said this isn't fair, and I think Congress has taken notice of that. We're actually monitoring that specifically because we do think this is a really unfair result. It really seems unreasonable to impose it on a gross basis, but there are a lot of things, particularly in these international provisions, that don't really hang together very well. So we're really hoping to get some resolution on that. And again, we are playing catch up with the OECD with their base erosion measures. We alluded to that before. I think the most important thing to remember here is that we're just getting started in the U.S. with the BEAT tax. It does seem like OECD is partnering with Treasury to basically, I think, get the results that they've been wanting for years. I don't think that we're so far behind that it's going to be a sea change, on the international scale. But it is important to know that this is just one small piece of that overall issue.
The next issue we'll discuss is the global intangible low tax income tax, otherwise known as the GILTI tax. This was designed to impose a minimum tax on companies holding patents and copyrights offshore, specifically to address certain large corporate inversions, which have received a lot of media attention recently. We have the Pfizer inversion. These are situations where a company has possibly primarily holds a lot of intellectual property, merges with a smaller company in a low tax jurisdiction, or otherwise moves their legal domicile to a lower tax jurisdiction, such as Ireland or Luxembourg. Because they have so much value in their intellectual property, they can then shift that intellectual property to the low tax jurisdiction while maintaining the bulk of their operations in the United States. The hope of enacting this tax is to encourage companies to bring the intellectual property back domestically. Significant deductions allow the effective tax rate to be 10.5% through 2025 before increasing to just over 13%. Again, the hasty drafting has led to some unintended consequences. Specifically, the Act doesn't define intangible. As we said, everyone is tax professionals are kind of all the same mind. This is meant to target intellectual property. So one would think that the intangible assets being referred to were trademarks, licenses, patents, but it just says intangible assets undefined. The big fear is that this could be applied to any intangible assets read broadly, including assets such as goodwill or going concern value held by a financial institution. So a bank with operations in the U.S. and also abroad, if they hold a large amount of goodwill or going concern value abroad, if read literally, this tax could be read expansively to include those assets as well. This would hit these institutions with a large tax that would not normally be incurred until they repatriated the income.
Thanks, Ryan. I think we're getting close to the end, so we will try to get through the rest of this a little bit more quickly. The third piece that we just wanted to touch on, because it can include interest deductions, of course, from within the U.S., are the new so-called hybrid rules. The new law denies a deduction for disqualified related party amounts that are paid pursuant to hybrid transactions and to hybrid entities. The definition of disqualified related party amount or interest, which is why we're talking about it here, or royalty payments that are made to a foreign party where there's no corresponding inclusion in the other countries, such as, for example, Canada, where the payment might be a return of capital, or two, there's an available deduction for the amount of the payments under the tax law of the other jurisdiction. Hybrid transactions are transactions in which the interest or royalty payments are not treated that way under the tax laws of the foreign jurisdiction. Similarly, hybrid entities are treated as transparent in the U.S., but not as transparent, meaning as a corporation, in the other country, or vice versa. This will impact complex international financing structures, and it may incentivize borrowers to look to replicate the structure outside the U.S., but as noted, other countries are somewhat ahead of us in this area. So one other point on that, a lot of those hybrid structures did rely on an end lender being outside the U.S., such as a non-U.S. bank. So as companies in these structures revert to more traditional lending, we may see an uptick in U.S. bank borrowing.
All right, our final issue is some issues with controlled foreign corporations. Specifically Section 956, which is enacted to prevent domestic companies from benefiting from the income of their foreign subsidiaries, particularly from a domestic borrower having a foreign control foreign company from acting as from pledging all his assets in a collateral security package to back up a domestic borrower. Under the so-called deemed dividend rule, the CFC has to limit its pledge to 65% of its assets. Otherwise, its income could be viewed as taxable. It could be a deemed dividend and viewed as taxable in the United States. There's also a debate regarding whether CFCs can act as guarantors as well. Interestingly, in both the House and Senate bills, this was dealt with. This issue was removed.
For U.S. corporations.
For U.S. corporations. However, somehow in the final bill, this did not occur. So we still have to deal with this issue, and as Michelle Smith mentioned, it's actually broadened somewhat.
That's correct, Mike. Yes, we're still stuck with CFCs not being allowed to be guarantors, and that 65% limitation that our finance partners are very well aware of. They love hearing from us about that. But there, yes, very quickly, the CFC definitional rules have changed a little bit. Notably, who can be a U.S. shareholder who's counted towards whether or not a company is a CFC and whether or not that shareholder has to include some part of income and income has changed from just vote to vote or value, which may cause some previously non-CFCs to become CFCs under the rule. Significantly for borrowers with structures with brother, sister, U.S. foreign corporate entities, a U.S. borrower typically would not have a CFC if its sister corporation was owned by a foreign parent, because the attribution rules that would cause that result were turned off. Well, now they're turned back on. So that's something that borrowers and banks will want to review to see if they all of a sudden have to bring the CFCs in their structure. They may have to address that in their credit agreement. So I believe we have gotten down to the wire. I don't believe, do we have any time for questions?
I think we have a few minutes for questions. Okay. So we'll take some of the questions that we've received. How about we start with Michelle and Ryan? A question about debt restructuring. Do these provisions raise other concerns with respect to debt restructuring? For example, will the NOL limitation impact attribute reduction?
That's a good question. I mean, we focused in our discussion on taxable COD income, but more often than not, a troubled debtor will be able to exclude COD income, but they will have to reduce their tax attributes. NOLs, well, I guess one point that's important is that NOLs generally come first unless the borrower makes an election to reduce depreciable basis first. That may be limited now because of immediate expensing, for example. There may be less basis going forward to reduce as an attribute. Also, basis may not be quite as valuable because basis equals depreciation, which, as we noted, is a little bit less valuable because of the lower rate. Similarly, NOLs are a little bit less valuable, but and again, the NOL is also impacted by the 21% rate. It may not. I do think that in some respects it'll be more of an issue of how the calculations will play out rather than what debtors do. But I think probably the biggest point on the decision tree is, do we put our basis first? So that will really depend on an individual borrower.
Another question, this one for Vivian and Liam. Will wind turbine purchased before 2017 to satisfy the start of the construction date be eligible for 100% bonus depreciation?
Yeah, that's interesting. So we know a lot of the project developers have stockpiled wind turbines to satisfy the safe harbor expense requirement in order to be considered having started the construction of a project before 2017 to qualify for 100% PTC rate. The 100% bonus depreciation in the TCJA requires the property to be both acquired and placed into service after September 27, 2017. The date of the acquisition for that purpose is not when it's delivered, but when the rates and buying contract was entered into. So for those wind turbines, for which the rates and binding contract have been entered into before the September 27, 2017 cutoff date, those wind turbines will be eligible for the previous 50% bonus depreciation, even if such wind turbines are placed into service on a wind farm post the September 27, 2017 date.
Thanks. We're going to take one more question, this one for Liz and Stephen. Are you seeing any reasons to elect out of the new 100% bonus depreciation regime?
I think that we're seeing, similar to under prior law, we would expect taxpayers to elect out of the new regime to the extent that there's some limitation or some reason they can't get the full benefit of the 100% expensing. One example that comes to mind for a C corporation taxpayer, taking the whole cost of a property as an expense right away, that would generate an NOL. As we discussed earlier today, NOLs can't be carried back anymore, and when carried forward, it can only be used to offset 80% of income. So right there, you have a pretty significant limitation to how to a taxpayer's ability to utilize that deduction. So in that situation, for example, we would expect a taxpayer to consider electing out of bonus depreciation and then taking the depreciation deductions under makers, under normal makers rules, and then possibly being better able to match taxable income to taxable expense, and then perhaps get the full benefit of those deductions over time rather than taking the haircut on the usage of those deductions if used as an NOL carry forward.
Thanks. We are unfortunately out of time, so I want to thank everyone who was able to join us. If you have questions for any of our speakers, please feel free to reach out to them. If you've submitted a question and we haven't had a chance to answer it, our speakers will get back to you. Thank you again.